Regional property investment in Australia has been one of the hottest topics in real estate over the past few years. During COVID, everyone was talking about the regional boom. Prices in small towns and regional cities were jumping 20%, 30%, even 40% in some cases. People were leaving Sydney and Melbourne in huge numbers, chasing lifestyle, space, and affordability in regional areas. But now, in 2026, things have changed. Some regional areas are still performing strongly. Others have stalled completely. Some have even seen prices fall after their COVID boom. This creates a big question for investors. Is regional property investment still worth it, or should you stick with capital cities? I've analyzed data from hundreds of regional areas across Australia. I've compared regional performance to capital city performance over different time periods. I've looked at which regional areas are succeeding and which are struggling. And I've identified the specific factors that separate good regional investments from bad ones. By the end of this video, you'll understand the real advantages and disadvantages of regional property investment. You'll know which types of regional areas are worth considering and which to avoid. You'll learn how to identify genuinely good regional opportunities, and most importantly, you'll be able to make an informed decision about whether regional property fits your investment strategy. Let's start by looking at what actually happened during the regional boom and what's happening now. The regional boom. What happened and why? Between 2020 and 2023, regional Australian property went absolutely crazy. Let me give you some real numbers to show you how extreme this was. Byron Bay's median house price jumped from $1.1 million in early 2020 to over $2 million by late 2022. That's an 80% increase in less than 3 years. The Southern Highlands in New South Wales saw median prices jump 50%. The Sunshine Coast in Queensland went up 60%. Even small inland towns like Orange, Ballarat, and Toowoomba saw increases of 30 to 40%. Regional vacancy rates dropped to historic lows, in many cases below 1%. Regional rents increased faster than capital city rents. Regional auction clearance rates were higher than Sydney or Melbourne in many weekends. It was genuinely extraordinary. Why did this happen? Several factors came together at the same time to create a perfect storm for regional property. First, COVID lockdowns made people reconsider where they wanted to live. Being locked in tiny apartments in the city made people crave space, yards, and nature. Regional areas offered all of that. Second, remote work became normal. Companies that insisted everyone work in the office suddenly had no choice but to allow work from home. If you could work from home permanently, why pay Sydney prices when you could live by the beach or in the mountains for half the cost? Third, interest rates dropped to record lows. The Reserve Bank cut rates to 0.1%, and banks offered loans at under 2%. This increased borrowing capacity dramatically, and people used that capacity to buy bigger houses in regional areas. Fourth, government stimulus and support payments put money in people's pockets. Many people had more savings than ever before because they couldn't spend on travel, entertainment, or going out. They used those savings for property deposits. Fifth, capital cities became less attractive. Melbourne had endless lockdowns. Sydney was expensive and stressful. Brisbane was getting crowded. Regional areas looked more appealing by comparison. All of these factors together created massive demand for regional property. But here's the critical point. Many of those factors were temporary. The regional reality. What's happening now? Fast forward to 2026, and the regional property market looks very different. Some regional areas are still performing well. The Sunshine Coast, Gold Coast, Geelong, and Newcastle continue to see solid price growth and strong demand. These areas are holding their gains and adding to them. But many smaller regional areas have stalled. Towns that saw 30 to 40% growth during COVID have seen prices flatten or even fall over the past year or two. Vacancy rates have increased from under 1% to 2 or 3%. Properties are taking longer to sell. Rental demand has softened. What changed? The temporary factors that drove the boom have reversed. Remote work is much less common now. Many companies have mandated return to office either full-time or several days per week. People who moved to regional areas for remote work are now facing 2-hour commutes to capital cities, or they're moving back to the city. Interest rates have gone up significantly. The cash rate went from 0.1% to 4.35% before recent cuts. Even with the cuts bringing it to 3.6%, rates are much higher than the 2% people were paying in 2020. Higher rates mean lower borrowing capacity and less ability to pay premium prices. Cost of living pressures have hit everyone. The money people had saved during COVID has been spent. Inflation has eaten into people's budgets. There's less spare money for property investment. Capital cities have become more attractive again. Melbourne has recovered from lockdowns. Sydney prices have started growing again. Brisbane's Olympic excitement is building. People who left cities during COVID are reassessing whether regional life is really for them. The result is that regional property investment has become much more selective. You can't just buy any regional property and expect it to boom. You need to be very careful about which regional areas you choose. The advantages of regional property investment. Despite the changes since the COVID boom, regional property still has genuine advantages that make it worth considering for the right investors in the right locations. The first big advantage is affordability. Regional property is significantly cheaper than capital city property. The median house price in regional Australia is around $689,000 compared to $927,000 in capital cities. That's a $238,000 difference. This affordability means you can enter the property market with a smaller deposit, or you can buy multiple regional properties for the price of one capital city property. The second advantage is rental yields. Regional properties typically generate better rental yields than capital city properties. It's not uncommon to find regional properties yielding 5% to 7%, while capital city properties might only yield 3% to 4%. Higher yields mean better cash flow. The rent covers more of your costs, which means you're paying less out of your own pocket to hold the investment. Let me give you a real example. A $500,000 house in a regional city might rent for $450 per week, which is $23,400 per year. That's a 4.7% yield. A $900,000 house in Sydney might rent for $650 per week, which is $33,800 per year. That's only a 3.8% yield. The regional property gives you better return on your investment dollar. The third advantage is that regional areas often have less competition. In hot capital city markets, you might be competing with 10 or 15 other buyers for the same property. Auctions are stressful, and properties sell for well above asking price. In regional areas, there's often less competition, which means you can negotiate better deals and pay fair prices rather than inflated auction prices. The fourth advantage is that regional properties are often larger. For the same money that buys you a 2-bedroom unit in Sydney, you can get a 4-bedroom house on a big block in a regional area. Larger properties can appeal to families, which means longer-term tenants and more stable rental income. The fifth advantage is lifestyle appeal in some regional areas. Beach towns, wine regions, and mountain areas have genuine lifestyle attractions that will always create demand from people seeking quality of life. These locations have enduring appeal that isn't just based on temporary trends. The sixth advantage is that some regional areas are growing genuinely. Not all regional areas are small declining towns. Cities like Geelong, Newcastle, Wollongong, and the Gold Coast have populations of 300,000 to 700,000 people. They have diverse economies, universities, hospitals, and employment opportunities. These are proper cities that happen to be outside capital city boundaries. Now let's talk honestly about the disadvantages, because regional property investment comes with significant risks that capital city investment doesn't have. The first major disadvantage is lower capital growth over the long term. This is the big one. Over 20 or 30 years, capital cities have consistently outperformed regional areas in capital growth. Yes, regional areas have boom periods like we saw during COVID, but over the long haul, capital cities grow more consistently and usually by larger total amounts. The data shows this clearly. Over the past 30 years, Sydney has grown about 6.8% per year on average. Melbourne has grown about 6.5% per year. Regional areas have grown about 5% per year on average. That might not sound like a big difference, but compounded over 20 years, it's enormous. A property bought for $500,000 growing at 6.8% per year is worth $1.86 million after 20 years. The same property growing at 5% per year is worth $1.33 million. That's a $530,000 difference in wealth created. The second disadvantage is limited liquidity. Liquidity means how easy it is to sell an asset quickly. Capital city properties are highly liquid. There are always buyers in Sydney or Melbourne. You can sell relatively quickly if you need to. Regional properties are much less liquid. In small regional towns, there might be very few buyers. Your property might sit on the market for months. If you need to sell urgently, you might have to accept a low price. The third disadvantage is economic dependence. Many regional areas depend heavily on one or two industries. Mining towns depend on mining. Agricultural towns depend on farming. Tourism towns depend on tourism. If that key industry struggles, the whole town struggles, and property values fall. Capital cities have diverse economies across dozens of industries, which provide stability. Let me give you a real example. Karratha in Western Australia had a median house price of $850,000 in 2013 during the mining boom. By 2016, when iron ore prices fell, the median had crashed to $360,000. That's a 58% collapse. People who bought at the peak lost more than half their property value. This kind of boom-bust cycle is common in regional areas, dependent on one industry. The fourth disadvantage is limited infrastructure and amenities. Small regional towns might not have good hospitals, schools, shopping, or entertainment. This limits their appeal to certain demographics. Young professionals, families with teenagers, and anyone wanting urban amenities won't find what they need in small towns. The fifth disadvantage is demographic challenges. Many regional areas have aging populations. Young people leave regional towns to go to universities and cities and never come back. This creates declining populations in some regional areas, which is terrible for property demand. You can't have property growth without population growth. The sixth disadvantage is limited employment. The number one reason people choose where to live is employment. Capital cities have millions of jobs across every industry. Regional areas have limited employment opportunities. If you lose your job in a small regional town, you might need to move to find another one. This employment limitation caps how much demand there can be for housing. The seventh disadvantage is climate and natural disaster risks. Many regional areas face higher risks from bushfires, floods, or cyclones than capital cities. These risks are increasing with climate change. Properties in high-risk areas are becoming harder to insure or uninsurable. This affects property values significantly. Which regional areas are worth considering? Not all regional areas are the same. Some are genuinely good investments. Others are traps. Let me break down the different types of regional areas so you understand which are worth your money. The first category is large regional cities. These are places like Geelong with 280,000 people, Newcastle with 320,000, Wollongong with 300,000, the Gold Coast with 680,000, and the Sunshine Coast with 330,000. These are proper cities with diverse economies. Universities, hospitals, shopping centers, and employment. They just happen to be outside capital city boundaries. These large regional cities offer the best of both worlds. They have the stability and growth potential of cities, but with more affordability than Sydney or Melbourne. They're close enough to capital cities to benefit from spillover demand. They have genuine economic drivers beyond just one industry. Large regional cities are worth considering for investment. They've consistently performed well over long periods. They have strong rental demand from both students and workers. They have lifestyle appeal with beaches or proximity to nature. And they're unlikely to see the boom-bust cycles of smaller regional areas. If you're going to invest regionally, large regional cities should be your primary focus. Look at the Gold Coast, Sunshine Coast, Newcastle, Wollongong, Geelong, and potentially the Illawarra region. These areas offer solid fundamentals and reasonable growth prospects. The second category is satellite towns close to capital cities. These are towns within 1 to 2 hours of major capitals. Think of places like Ballarat and Bendigo near Melbourne, the Central Coast near Sydney, or Toowoomba near Brisbane. These satellite towns benefit from capital city proximity. People can commute for work if needed. They attract retirees and families wanting cheaper housing while staying connected to the city. They often have decent infrastructure and services because of their size and proximity to capitals. Satellite towns can work as investments if they have good transport links to the capital city. A satellite town with a direct train line to the city will perform better than one that's car-dependent with terrible traffic. But be selective. Not all satellite towns are equal. Research their employment, infrastructure, and population trends carefully. The third category is lifestyle regional areas. These are beach towns, wine regions, and mountain towns that attract people for lifestyle rather than employment. Think Byron Bay, Noosa, Margaret River, or the Southern Highlands. These areas have permanent appeal to people seeking quality of life. They'll always have demand from retirees, remote workers, and wealthy people seeking holiday homes. The lifestyle appeal provides a floor under property values. However, these lifestyle areas are often already expensive because of their appeal. Byron Bay isn't cheap anymore. Noosa is extremely expensive. You might not get good value. And these areas can be volatile. During good economic times, they boom as people have money for lifestyle. During recessions, they can fall as lifestyle becomes less important than employment. Lifestyle regional areas can work, but you need to be very selective and accept higher risk. Focus on areas with permanent populations, not just holiday destinations. The fourth category is mining towns. These are places like Karratha, Port Hedland, Mackay, and Gladstone that exist primarily to service mining or resources industries. Mining towns offer extremely high rental yields, often 7 to 10%. You can sometimes find positively geared properties that make money from day one. When mining is booming, these towns boom. But mining towns are extremely high risk. They have massive boom-bust cycles. When the boom ends, property values can collapse 30 to 50% or more. If you invest in mining towns, you need to deeply understand mining cycles and commodity prices. You need to know when to sell before the bust comes. This is not suitable for beginning investors. I generally recommend avoiding mining towns unless you're a sophisticated investor who understands the risks and actively monitors resource markets. The fifth category is small country towns and remote regional areas. These are towns with populations under 10,000 people, often hours from major cities. Think small agricultural towns, remote coastal villages, or inland country towns. These areas boomed during COVID as people fled cities seeking peace and space. But most have now stalled or fallen in value as the COVID factors reversed. These towns typically have limited employment, aging populations, and minimal infrastructure. Small country towns are high-risk investments. Yes, they're cheap. Yes, you might get high rental yields, but capital growth is likely to be minimal or negative over the long term. Population decline in these areas means falling demand for housing. I recommend avoiding small remote regional areas unless you have a very specific reason to invest there. The risks far outweigh the potential returns for most investors. How to identify good regional investment opportunities? If you've decided regional investment might suit you, how do you identify the actual good opportunities? Let me give you a framework for evaluating regional areas. First, look at population trends. Is the population growing, stable, or declining? You can find this data on the Australian Bureau of Statistics website. Look at population over the past 5 and 10 years. Growing populations create housing demand. Declining populations kill property markets. Only invest in regional areas with growing or at least stable populations. Avoid anywhere with declining population unless you have a very compelling reason to invest there. Second, analyze the employment base. What industries employ people in this area? Is it diverse or dependent on one industry? Check unemployment rates. Areas with unemployment above 6% are concerning. Areas below 4% are healthy. Look for regional areas with diverse employment across multiple industries. Healthcare, education, government, professional services, and construction are good signs. Heavy dependence on one industry like mining, agriculture, or manufacturing is risky. Third, assess infrastructure. Does the area have a hospital, a university or TAFE, good schools, shopping centers, a train line, or good road access to major cities? Good infrastructure makes areas livable and attractive. Regional areas with universities are particularly good because students create rental demand. Areas with major hospitals are good because healthcare employs lots of people. Good transport infrastructure connects the area to opportunity. Fourth, look at supply. How many new properties are being built? Are lots of new subdivisions going in? Too much new supply will limit price growth because supply competes with your investment property. Limited supply supports price growth. You can check building approval data on ABS website. If a regional area is approving thousands of new dwellings, be cautious. If approvals are low, that's better for price growth. Fifth, examine rental market data. What's the vacancy rate? Below 2% is tight and good. Above 3% is loose and concerning. What are rental yields? Are they attractive enough to justify the investment? How fast are rents growing? Strong rental growth indicates strong demand. Sixth, study price trends. What have median prices done over the past 5 and 10 years? Has growth been steady or boom-bust? Steady growth is better than volatile booms and crashes. Look at how the area performed during the last downturn. Did it hold up or collapse? Seventh, consider your exit strategy. Could you sell this property relatively easily if needed? Is there a decent-sized buyer pool, or would you struggle to find buyers? Don't invest in properties you couldn't sell in a reasonable time frame. Use all of these factors together to evaluate regional opportunities. No single factor tells the whole story. You need to look at the complete picture. Capital cities versus regional, the long-term comparison. Let me give you the hard truth based on decades of data. Over the long term, capital cities have outperformed regional areas in total wealth creation through capital growth. Yes, regional areas often have better rental yields. Yes, they're more affordable. Yes, they sometimes have boom periods where they outperform cities for a few years. But over 20 or 30 years, capital cities win on capital growth. Why? Capital cities have advantages that compound over time. They have diverse economies that don't depend on single industries. They have continuous population growth from migration. They have infrastructure investment that never stops. They have employment opportunities that attract working-age people. They have universities that attract young people. They have governments that prioritize capital city development. Regional areas struggle with all of these factors. Population growth is slower or negative. Infrastructure investment is limited. Employment opportunities are constrained. Young people leave for cities. Let me show you a real example. If you bought a median-priced house in Sydney in 1995 for $215,000, it would be worth about $1.7 million today. That's growth of 690%. If you bought a median-priced regional house in 1995 for $130,000, it would be worth about $689,000 today. That's growth of 430%. Yes, the regional house was cheaper to buy, but the Sydney house created $1.485 million in equity compared to $559,000 for the regional house. The Sydney house created nearly 3 times as much wealth despite costing more. This pattern repeats over every long-term period you examine. Capital cities win on wealth creation through capital growth. So does this mean regional property is never worth it? No, it means you need to understand what you're investing for. If you want maximum capital growth over 20+ years, capital cities are the better choice. If you want better cash flow and rental yields, regional areas can work. If you have limited deposit and can't afford capital cities, regional large cities offer reasonable alternatives. Who should consider regional property investment? Regional property investment isn't for everyone. It suits certain investor types and situations, but not others. Regional investment suits you if you have limited capital and can't afford capital city entry prices. If you only have $80,000 saved, you probably can't buy in Sydney or Melbourne, but you might afford a regional city property. Getting started in regional areas is better than not investing at all. Regional investment suits you if cash flow is your priority over maximum growth. If you need your investment property to be positively geared or close to it, regional properties with their higher yields can deliver that. Regional investment suits you if you live in or know a regional area very well. Local knowledge is valuable. If you've lived in Geelong for 20 years, you understand that market better than Sydney investors. That knowledge edge helps you make better decisions. Regional investment suits you if you're a sophisticated investor building a diverse portfolio. Experienced investors might add regional properties alongside capital city properties for diversification and yield, but this is for people who already have capital city properties as the foundation of their portfolio. Regional investment doesn't suit you if you're seeking maximum long-term capital growth. Capital cities are better for this goal. Regional investment doesn't suit you if you need high liquidity. If you might need to sell quickly, capital city properties are easier to exit. Regional investment doesn't suit you if you can afford capital cities. If you have the deposit and income to buy in Sydney or Melbourne, you'll likely build more wealth doing that. Regional investment doesn't suit you if you're risk-averse. Regional markets are more volatile and riskier than capital cities. So, after all this analysis, is regional property investment worth it? The answer is, it depends. Regional property investment is worth it if you focus on large regional cities with genuine economic fundamentals, diverse employment and infrastructure. Places like the Gold Coast, Sunshine Coast, Newcastle, Wollongong, and Geelong offer reasonable growth prospects combined with better affordability and yields than capital cities. Regional investment is worth it if your priority is cash flow and you're willing to accept lower long-term capital growth in exchange for better rental yields and positive gearing or near positive gearing. Regional investment is worth it if you have local knowledge of specific regional areas that gives you an information advantage over outside investors. But regional investment is not worth it if you're chasing small country towns hoping for another COVID-style boom. Those booms were driven by temporary factors that won't repeat. Regional investment is not worth it if you're looking at mining towns without understanding resource cycles. Regional investment is not worth it if you're expecting the same long-term capital growth as capital cities. The data shows clearly that won't happen. My personal recommendation is this. If you can afford to invest in capital cities, focus your investment there. Capital cities offer the best long-term wealth creation through capital growth. If you can't afford capital cities, consider regional cities as an alternative, but understand you're trading lower long-term growth for better affordability and cash flow. If you do invest regionally, be very selective. Focus only on regional areas with growing populations, diverse employment, good infrastructure, and genuine economic drivers. Avoid small towns, mining towns, and areas dependent on single industries. Regional property investment isn't bad. It's just different from capital city investment with different advantages, disadvantages, and risk profiles. Understanding these differences and choosing areas that match your goals is how you succeed with regional property investment.